Good afternoon, everybody. Welcome to the second briefing for this afternoon. We have the MIA, Madam Commissioner. A, congratulations, and B, welcome, and you can start when you're ready.
A slide presentation to click through if we'll all just walk through paper?
I don't know, but if you could move the microphone.
Yes.
Sonia.
Thank
That's
you.
about all I do know. One second.
Thank you. Oh, sorry. While we're getting that set up, let me again just say hello. It is nice to see you all. Happy session. Marie Grant, Acting Insurance Commissioner, subject to Senate confirmation this session. So what we're planning to talk about today, and Joy, I don't know if you want to introduce yourself.
Good afternoon. Joy Hatchett, recently appointed Deputy Insurance Commissioner.
So much of what we're going to talk about with you all this afternoon is just an overview of our authority over property and casualty, and specifically private passenger auto rate making. Thank you so much. Perfect. We're also going to talk about some findings from our market analysis of our market conduct data statement. In terms of what is happening and what's been happening in terms of rate increases over the past 5 years. Thank you. We also have, we're going to spend a little bit of time actually on homeowners insurance at the end, because we want to share with you some trends in the market. And I know given the current situation in California, homeowners insurance is on a lot of folks' minds. So we'll be talking about that as well. Okay. So just a little bit about us. We're an independent agency here in Maryland. We license insurers and brokers. We examine the business practices of our licensees. We monitor the solvency of insurers to make sure that they are able to pay claims for our consumers. We review and approve insurance policy forms. We review insurance rates in the property and casualty space, specifically to ensure that those rates are not inadequate, excessive, or unfairly discriminatory. And then we also investigate consumer and provider complaints, as well as allegations of fraud. So in general, in terms of property and casualty, which you all oversee for us in the General Assembly, the types of insurance that we regulate include homeowners insurance, and that includes everything from renters policies to condo policies and mobile manufactured home policies, fire insurance, certain aspects of workers' compensation insurance, which is also regulated by the Maryland Workers' Compensation Commission, professional and business liability insurance, motor vehicle insurance, pet insurance, and travel insurance. Okay. Now, as we get into personal passenger auto, or what we call, I dislike acronyms, but we use this acronym a lot at the MIA, PPA, where we're really talking about specifically like our cars that we use for our personal use. That generally excludes commercial use of a vehicle. So for example, using a vehicle to provide delivery services like Uber Eats, that becomes a commercial use and is regulated a bit differently. If you ever have consumers that have questions about that, obviously we're a resource for that. I'm going to turn it over to Deputy Commissioner Hatchett to talk some more in detail about our approach to rate making under Maryland law.
Thank you, Commissioner. So I'm sure at this point you have seen or heard from your constituents lots of questions about the rates and the increasing of the rates. So we thought it would be important for us to give you a little bit of background on the rate making process. So as you all know, premium is the amount that is paid for the particular policy. And one of the things that we always try to make sure consumers understand is that policy is a contract. And under that contract, the consumers have rights, but they also have obligations. And the insurance companies are permitted to gather certain information when they are establishing that premium. So the premium is calculated based on particular rating rules and basically looking at those rules to determine the appropriate amount that should be charged for that policy or contract. And what we do is we review those, and this is a part I think that sometimes is a little bit hard to understand or explain to your constituents. Premiums are based on future projections. So it's based on what the insurance companies, through their review, think that the cost will be in the future. And when I say think, it's an actuarial algorithms that they basically project what will happen in the future. And that's how much the carriers determine is the appropriate price point to charge in terms of premium. And also something important to remember is that that price point is charged prior to and determined prior to the policy being effective. So here are some of the things that insurers take into account when they're looking at and determining how much to charge. Losses. So, and losses, they look at the losses for you as an individual, but more importantly, they look in general at all of the losses. So I know there's always a lot of angst about, well, why are premiums in one zip code different than premiums in a different zip code? And it's based on the loss experience for that particular zip code, because they're looking at remember, projections, how much they will end up paying out in that particular zip code. Then other things that are included in the expenses: general operating expenses, producer commissions, other marketing expenses, premium tax, regulatory fees, and here's a big one: the cost of reinsurance. What insurance companies do is they have to realize we can't necessarily take on all of the risk, so we have to purchase insurance on our business, and that's referred to as reinsurance. So they have to get someone, if they have a major loss, like what's happening in California, they have to go to the reinsurers to get money from them. So a lot of how much is paid in premium is based on how expensive it is to get reinsurance. And that number fluctuates. So the next slide really goes into more information about the rating, how rates are determined. There's something called a base rate, and then there are individual risk factors. So the base rate is where the companies sort of look across the board and say, okay, in this particular zip code, the average rate will be, let's say, $100. But then they want to look at you and your record. And so those are your individual underwriting factors, and that will help you get closer to how much your actual premium is. So it's not as if everyone has, unless the person, they live side by side, same zip code, And the actual same rating factors, same number of accidents, same number of miles, same everything, that's the only way you're going to have identical rates. Any one change, different vehicle, different number of tickets, different whatever, your rate is going to be different than the person that lives right beside you. And that, I think, sometimes is hard for consumers to understand, that there's this general rate, but then they also look at you. And so just remember that when your constituent is saying, well, Johnny down the street is only paying $50, why am I paying $150? You've got 5 cars, 4 of which are 2025s. That's why your rates are a bit higher. Other thing.
That's not intended towards anyone in the room.
Other things that they look at is, and I'm really focusing on the things that consumers call and question us about, because we get hundreds of calls every week, people complaining about their rates. And so that's what I'm focusing on, because I'm sure that's probably also the questions that you're getting. So we get questions, zip code, all the time. Why is it more expensive in my zip code? We get questions about miles driven. I only drive 15 miles. Did you tell your insurance company that? Make sure your consumers know, tell your insurance company you're not driving as many miles, so your rates may go down. The actual experience, more accidents, more tickets, higher rates. And this is something that we hear frequently, credit. And this is what we tell people. Not every insurance company uses credit. So if you've got great credit, find a company that uses credit. If your credit's not that great, go to a different company. Not every company uses credit. And some companies still look at other factors, such as a lapse in a policy. And people say, well, why is that important? It's all about risk. If you have been driving without insurance, the insurance company considers you a higher risk, and so they're going to charge you more. And then insurance companies will, to some degree, make adjustments. One of the major adjustments that the companies do is if you have multi-policies, multi-vehicles, all of those things are done before they come up with the bottom line premium. And just because you've been with a company for years doesn't mean that that's going to be the best price point for you. So encourage your constituents to shop around. Now, and this is something that it's important for people to know. We frequently hear consumers say that the MIA has allowed my insurance company to increase my rates. Not quite true. In Maryland, auto insurance is file and use. The insurance companies, once they make the filing with us, are allowed to start using that rate once they make the filing. Now, we'll review that rate, and also actually the commissioner, and she may or may not have an opportunity to talk about this, is putting in place some more stringent reviews of those rates. But once the company files them, they can start charging them. And based on the way that the law is currently written, they're allowed to charge those rates as long as they're actuarially justified and not unduly discriminatory. So we don't approve them, and while we review them, we have very limited authority. And that's important because frequently what we'll hear when consumers call us is, well, the agent said that the MIA allowed the company to increase our rates, and they shouldn't have. It's not the way it works. And as I said, all of this, for the way that we conduct our reviews, we make sure that those rates are in line with our regulatory authority. We may not like them, but at the end of the day, under the limited ability that we have, we don't have much choice but to allow the companies to charge those. Then also, and this is where I'll end, I think I pay too much for insurance. But at the end of the day, I want to make sure that if I have a claim, the insurance company has the amount of money in that company to pay my claim. So the rates have got to be adequate.
Great. Thank you so much, Joy. So that was, that sort of ends our section on what we are looking at, our statutory authority in terms of rate making for private passenger auto. But this next section of our presentation gets into what we are seeing in the market in terms of rates, as well as what the trends behind the increase in rates are, what those claims experience that our auto insurers are seeing. So first of all, much of the data I'm about to share with you comes from something called the Market Conduct Annual Statement, which was developed through the National Association of Insurance Commissioners as a uniform system of collecting key market data. And it's used to collect claims, underwriting, lawsuit, and complaint data for several lines of business, including private passenger auto insurance and homeowners insurance. So insurers report this data to each jurisdiction in which they're licensed and meet the premium threshold for reporting. So it is not all the auto insurers in our state, but it is close, and we'll get into some of that detail. Delegate Fraser Hidalgo, did you have a? Oh, no, you keep going. Okay. Okay. Thank you, Mr. Vice Chairman. 126 private passenger automobile insurance carriers reported this data to us in 2023, as well as 116 homeowners carriers. And so that information that we get is confidential. We can't share with you all the information, but what we can share with you is aggregate trends, and it has to be non-company specific. But it's a rich set of data, and it does allow us to see what is happening in the market. Okay, so just a little bit about our market. So in terms of 2023, excluding the Maryland Automobile Insurance Fund, which is a government agency, our payer of last resort in the market, 142 companies reported positive premium in their financial statements. And in total, those 142 companies wrote almost $6.5 billion in premium during 2023. 126 of those companies submitted MCAS data in 2023, and it really is almost all of the market, right? It's over 99%. And those companies had over 2.9, almost 3 million policies in force, insuring over 4.4 million vehicles here in Maryland at the end of calendar year 2023. So just a little bit about Maryland Auto and their data in terms of the statement. They don't submit data or financial statements or to MCAS or to the NAIC, but they do submit financial statements to us, and we do review those in a regulatory manner. And in 2023, they had about 1.56% of market share in Maryland. Okay, so this is a busy slide, but I'm gonna, it's an important slide. It reflects what we are seeing and everything we know. Auto insurers tend to file a proposed rate that is lower than that indicated rate. So in a competitive marketplace, that might make sense for any number of reasons. So the indicated rate, you can see the overall range where you have a very high in 2017 of 29%, and then a low. In some cases, you have companies filing decreases in 2017. In terms of proposed, you had a high of 12.5% and then low of negative 2.5%. So if we go through the proposed, again, like 2018 through 2020, the overall range of what auto insurers were filing was not that high. It was within a tighter range. In some cases, particularly in 2020, when there weren't folks on the roads, they were filing for decreases. But then as you get into 21, and you look at the experience 21, 22, 23, 24, you see those highs very high, and even those lows, we don't see companies filing for decreases. We see companies filing for increases that may be in the single digits. And even those proposed, right, are lower than the indicated rates on the other side of the table. And so what this chart tells us at the MIA is that there is, significant increases happening over the past several years in private passenger auto insurance, but it's probably based on risk that they are seeing that is even higher than the rates they are filing with us. And so we'll talk a little bit about what that risk might look like. Okay. So one of the biggest things that we think are contributing to these insurance rates is the inflation writ large. So that might be increased costs of cars, increased sophistication of the parts that go along with cars, and then the cost of wages for repairs as well. So the actual repair cost based on the car parts as well as the labor associated with it is really going up. We're also seeing claims increases overall. We've seen an increase of a little under 5% in our MCAS data of the number of claims opened under insurance policies, indicating exposure, and that's a reason why rates may be going up as well. Distracted driving spiked during the pandemic. It still remains a pervasive issue according to the Insurance Information Institute, which may be leading to more accidents and then which drives up claims and losses. And as I just talked about, and then those claims and losses are also rising in and of themselves because they're more expensive. There is some research that suggests in some cases that telematics programs, which are authorized under Maryland law, and allow insurers to analyze risk profiles and tailor rates based on individual driving habits, often through tracking within the car itself, can help to measure accurately the risk, potentially. And then, again, related to telematics, there was a survey that reported that 45% of drivers participating in those programs made significant safety-related changes to how they drove, and then 35% reported making small changes. So those are some of the benefits, potentially, of telematics. We're also seeing in that MCAS data an increase in non-standard business being written, which may indicate that auto insurers are tightening underwriting standards, and they've placed more folks in the more expensive substandard market for insurance. Non-standard insurance is offered to drivers who are considered by these companies to be higher risk, often due to a history of accidents or traffic violations, and then premiums are typically higher for a non-standard policy than for a standard policy. So again, based on this data, we're seeing an increase in the number of carriers writing this business, and then we're also seeing an increase in the average percentage of those carriers' business that is non-standard rise, I would say, in a pretty meaningful way. So that was about 26% in 2021. It's up closer to 34% in 2023. This is just a little bit about discounts that are often available for consumers that are offered by auto insurance carriers. So those can include a good driving record, taking a defensive driving course, being a good student, having safety devices on your car, having anti-theft devices, bundling coverage, discounts for renewals, maybe employment or membership discounts, telematics programs, which I touched on briefly, as well as some carriers have pay per mile programs where, again, they are tracking via something on your vehicle, the number of miles you're driving. So instead of having to report, they get that data right away. These are just a few, so we have an extraordinary amount of information on our website for consumers to help consumers shop, to explain what's happening in this market and what consumers can do about it. We do also provide a comparison guide to rates that we update periodically. That is on our website as well and provides a really in-depth overview of rates in the market. I want to just pause there and also just talk to you about what we are doing at the MIA. I've given you a lot. This is the lay of the land. This is the rules under which we operate. But there are a few things that we want to do going forward. So the first is, as Deputy Commissioner Hatchett mentioned, though we have limited authority in this space, we do have authority in this space, and I want to make sure that we are using that current authority to really look at affordability for Maryland consumers. So we do have a new actuary on our P&C team who is looking more closely at the rates that our auto carriers file. So that's the first thing. What can we do? And our teams are exploring what can we do within the authority we have. The next thing that we are going to be doing this year is really taking a deep look into auto insurance affordability across Maryland, right? Taking an in-depth look at what is happening in the market, and then what additional authority we might need to really take a good look. We want to make sure that it's a competitive market. We want to make sure that insurance is available. At the same time, we want to make sure that we really understand what's going on in the market and that folks aren't subject to increases that aren't justified because this is an important product, right? There is a mandate to buy auto insurance. People need auto insurance to get where they need to go. It's really important to make sure that we're doing everything we can to ensure these products are as affordable as we can make them. So the next thing That ends actually our presentation on auto insurance. We do have a few slides on homeowners insurance, Mr. Vice Chairman. I don't know if we want to take questions now or, okay. Okay, great. So again, as we talked about, this is also an area that we've been monitoring closely, different dynamics in this market, but similar pain that consumers are feeling. We are seeing increases. We are seeing changes in this market. So we recently completed a report using that same data I mentioned, and Deputy Commissioner Hatch is going to talk about some of the findings of that report.
So what we found was that from 2021 through 2022, there was essentially a decrease in the number of new policies. Now, we're beginning to see that the new policies that are written started to increase in 2022 and 2023. That said, that increase, you can't really pinpoint why. Is it because of sort of what we saw after COVID, or are there some other factors? I mean, so we truly don't know the reason. All we can really look at is the overall data. Now, what we also saw was that there was an increase in the number of non-renewals. And as you all know, that there are limitations as to when a company can non-renew, but they are permitted to non-renew if the particular policy is not written in accordance to the company's underwriting guidelines. So, but we did see that there was an increase in the number of non-renewals. Now, why? Once again, we don't know, but some of the things that could have caused that was that people weren't doing the appropriate maintenance. I don't know if any of you are familiar with one of the reasons that a company may choose to non-renew you. Let's say you have a railing that's loose. The insurance company might say, well, according to our underwriting guidelines, that railing, if it's loose, it could cause injury. So you must keep your railing maintained. The insurance company will send a notice. If the consumer ignores that notice, that could be a basis for non-renewal. So the specific reason for that non-renewal, we don't know, but lack of maintenance could very well be, during this period of time, one of the primary drivers for those non-renewals. And one of the other, as I said, one of the big reasons is underwriting guidelines. So different companies, based on their underwriting guidelines, are looking at those and determining if you don't meet that set of criteria. One of the complaints, once again, and you probably will hear this from some of your constituents, when I first started doing this, and I won't say how long ago that was, companies almost never did inspections. They never came to your house to look to see the condition of your home. Companies, under the terms of that contract, are permitted to do that. And that's where they find that you've got that loose railing. So if your constituent complains to you, well, the insurance company came to my house. Under the terms of the contract, they're allowed to do that. Non-payment of premium is another big reason for cancellation and non-renewal. A lot of people will say, well, don't we get a grace period? Insurance companies do not have to give consumers grace periods. They're entitled to cancel your homeowner's policy even if you're one day late. Make sure your constituents understand that. The writing of new business. Some of the companies are getting stricter with respect to that. One of the things that we have found is writing and finding coverage on the coast is getting more and more difficult. The commissioner held a hearing because we heard from people down in Ocean City that people with mobile homes weren't able to find coverage. It's all about risk. The insurance companies evaluated the risk, and a lot of them have made determinations that that's not an area that they have an appetite to continue to write business. That's a part of what they're permitted to do under the current law. So just briefly, and I won't, because I know that you guys probably have lots of questions. I'm going to go through very quickly some of the restrictions that we have found. One of the biggest restrictions now is the age of the roof. More and more companies are limiting the payments based on the age of the particular roof. So we would tell make sure that your constituents understand that, because that is another example of hardening of the market. 30 years ago, it was relatively easy to find a company that would write a policy that would replace the roof under RCV. Replacement costs. More and more companies are turning to actual cash value and either aren't willing or will only pay a limited amount for roofs 15 or so years old. And this also comes with the importance of the maintenance. Because if you don't maintain that roof, depending on the particular company guidelines, it might be a basis for them to non-renew you. So once again, making sure that the consumers understand the terms of their policy and what, if they have a claim, the policy will also actually pay. The other thing that has been a part of the hardening of the market, and you all have seen this, is the increase in deductibles. At one point, people paid a $500, maybe $1,000 deductible. Now it's moved to percentages, and it's not a percentage of the claim. It's a percentage of how much the home was insured for. Many consumers don't understand that and don't realize that until they have a loss. Also, frequently, there's more than one deductible. There's a deductible for just your regular fire. There may be a wind deductible. There may be a separate deductible for your roof. All of those are parts of the hardening of the market. And I'll be quiet now.
So here, that's the end of our presentation. Here is our contact information. But I did just want to wrap up a little bit with about the situation in California, which we are watching very, very closely. I want to emphasize that California's market for homeowners insurance is very different from Maryland's market in terms of risk, in terms of how it is regulated, in terms of even in Maryland, we have a relatively small insurer of last resort for homeowners, the JIA. California, by contrast, has a very large state-run plan that you may have seen in the news called the California Fair Plan. So the dynamics are different, but certainly we are watching that closely, and the impacts that it has on our insurers here in Maryland will also be closely monitoring.
Thank you so much. Delegate Fraser Hidalgo.
Thank you, Mr. Chair. Thank you both for coming in and delivering us all this wonderful news. With that said, one of the things that you alluded to earlier was your ability to affect rates. It's file and use. While you didn't say it, I got the impression, just kind of reading between the lines, that maybe other states' commissioners have more and or less power to affect rates. But again, without you actually saying it, where do we stand in that, that broad spectrum of ability to affect rates as a commission or you as a commissioner in regard to the rest of the states? And are there adjustments that you would like to see happen? I mean, are we confident that the rates that are coming out of file and use are actually accurate? Or are we going, well, I guess, yeah, well, they filed it and then now they're using it. What's going on? What am I missing?
Thank you, Delegate Fraser Hidalgo. So states, insurance being a state-run business, there is a variety of ways that states are regulating auto insurance premiums. And again, at the end of the day, there's a lot of risk there, and the risk is rising. But some states, for example, say, hey, give us 60 days to look at this, right? That is in their statute before you go out and use that. I'm not sure if it's actually in auto insurance, but I do know that in other P&C lines, some states say, if the increase you file is above 10%, let us take a look at it, right, more closely and give us a certain time before you go out and use that. I will say, and I want to emphasize, I do think a lot of our auto insurance carriers, even though we are file and use, they do wait for our sign off often, not always, but often. There are other states with broader authority that I think, again, I'm hoping that deep dive, that study, that look will help us inform us on the best way we might think about that for Maryland. The other thing I'll say is, again, even under the standard that we have, one of the things we're learning, I mentioned we have a new actuary. There are other states, even within that standard, that are asking some harder questions. And so that's an action that, again, we're starting right now, asking harder questions about the increases that come across our desk.
Okay, so we can communicate more in the future about what you may deem as more model states commissioners to kind of check whether there's any, And then my follow-up, because Deputy Commissioner Hatchett, you mentioned it, and then the chair or vice chair looked at me, we both looked at each other and goes, really? So if you, for whatever reason, forget, don't pay your homeowner's insurance by the 30th or whatever date it is, for whatever reason, and you come back like a day or two late, and in the meantime, your house is either burned to the ground or got hail damage or whatever, the insurance companies have the legal right to just walk away, even if your check got stuck in the mail or whatever it is.
We have seen it happen.
In the state of Maryland?
In the state of Maryland.
Where the homeowner...
Well, the homeowner... Now, I can't say about check getting caught in the mail.
I understand, but just the payment.
The homeowner missed the payment. Bad thing happens. Under the terms, unless in that contract, there is written in leadway, but most companies don't have that. You've got on the life and health side, there's a grace period that's built in.
Set in statute.
Right, I've actually seen it on the life side, right. Yeah.
But there is no such grace period on the property and casualty side.
So, okay. Wow. So you could pay your premiums for 10 years and then miss a payment for whatever reason. You could be a great client and miss one payment, and your house burns down and you just lost $500,000 or $300,000.
That, sadly, that is correct, and we've seen it.
For life, is that Maryland state law that there must be a grace period, or is it just the general practice?
That is in, and we can get back to you with the section of the code, but that is by law.
Yeah, and in
Okay.
health, that's by law too. Yep.
Okay, yeah, if you could get back to me, I'd appreciate it. Thank you, Mr. Chair.
Thank you, Mr. Vice Chair. Just a couple quick questions. We all know, when we get on Facebook, we know we're reading facts, right? One of the things I've had, and this is kind of funny, actually. This is kind of funny. As you get on there, I've had a significant number of calls, and I've actually called into MIA about it. On Facebook, it says for drivers who drive less than 10 miles, there's the special rate. It's a Maryland law. Is there any, it's not credible. First of all, it's just an insurance company putting that out there that if you drive fewer miles. But it sounded like they've actually stated that Maryland law now states you can get the discounted rate. Is there any checks and balances for that?
Checks and balances for what they post on Facebook?
It says
or-
Maryland law has changed for motorists who drive less than 50 miles a week or whatever it is.
Paper mouth advertising.
I don't think that we have any control over.
You don't have control over me lying.
Well, let me, let us get back on to you on that. So first of all, I think to the extent, if it's pay per mile advertising, that is authorized under Maryland law. Perhaps there is some creative spinning in the advertising about how that's happening. But in general, we do have some broader authority to look at unfair and deceptive trade practices.
In real estate,
Yeah.
we're accountable for stuff like
Yeah.
false advertising that's generically stated,
Yeah.
which
Yeah.
that is. It's not legitimate.
Yeah.
That's one thing. I don't know how we can
Okay.
address that. The other thing, you talked a little bit about roofs, homeowners and stuff like that.
Yeah.
Is there any, I sell real estate sometimes for a living, and one of the things we're finding is if I have a 50-year-old roof, a 50-year guaranteed roof, they're still holding to that 15-year mark. And it's kind of like it's defeating what I purchased when I bought this 50-year-old shingle, if you will, that's guaranteed. And I'm sure, I didn't hear you say this, but I'm sure there's a correlation between what you can pay, what the insurance will pay out and what is covered by the warranty. Is there a correlation between that?
So I don't know that there's a correlation. What I suspect is going on, and we should talk more offline because I'm interested in learning more about what you're seeing in the market. The roofing company is giving that warranty, which is not insurance, it is a warranty, based on the information that they have. And then the insurance company is building their rates and their underwriting guidelines on what they have. And I think they are doing those in two separate worlds.
There has to be some checks and balances in that.
Yeah.
I mean, because it's killing real estate deals.
Yeah.
When I sit there, I'm going to sell my home and I accept the price on it for this much, and then I got to find out I got to spend $25,000 for a roof that still looks good, but because you say 15 years is your limit, I now, or somebody now has to incur that roof, I have to accept that responsibility. I think that's a problem in the industry. You might want to talk about
Okay.
addressing.
Yeah.
The other problem with the homeowners stuff is I have had a number of homes, waterfront homes, beautiful homes that cannot get fire insurance, and I cannot understand why with the body of water sitting right next to them. The insurance companies are sitting back saying, we're not going to do that. I live in a district that has a tremendous amount of volunteer fire departments. What they do, we don't have infrastructure like the cities. So we have to rely on that stuff. And I'm not seeing a whole lot of give on the insurance companies. They're pretty arrogant about it, yes or no. And there's only a few companies that are actually writing a lot of that insurance. Is that a problem for you all?
It's a concern in general, I think, as we, the survey we just did, the market hardening survey, and more to come, I think we are seeing overall underwriting guidelines, to your point, just exclude waterfront communities. So that's not writ large, right? It's a handful, but it's certainly, we are seeing that growing. So it is something we're looking at very closely.
Okay, two more questions. Just something to be. Is there a list that you could provide us that is the whole list of everything an actuary looks at? Every actuary. Is there a combined list that I can sit down, when we get somebody who's sitting in here saying, people that live on my street get higher rates than I do, and you guys come in here sitting down saying, well, you have to understand every insurance company has risks. We always ask, what do these, who are these actuaries? Do they even exist, or did you just arbitrarily come up with numbers?
So they do exist. We work with them. They are wonderful, very knowledgeable people. But to your point, I think what we can do is take a look at and see if we can provide you a list of like what property and casualty insurance actuaries are looking at. There's also, there is a trade association, and there's a whole accreditation for property and
It
casualty.
would eliminate a lot of bills if we could actually identify some of that. I think the last one, how's marijuana affected?
So we didn't take the look in terms of the actual. To your specific question, I don't know if I can answer it, but I think going back to what we talked about in terms of distracted driving and some of these increased frequency of accidents, to the extent that there is a correlation between that, but we're definitely seeing an increase in accidents since 2021. Whether you can put that on marijuana or cannabis, I can't say.
I'm good, thanks. Thank you.
Mine did too, but it came from God, so. Anyway, a two-part question, just to piggyback off Fraser Hidalgo. I was listening, I didn't hear it, I thought he'd ask it, but when you said that they get dropped for maybe missing one payment, that's without any forewarning, foreknows, they can just do it as they please?
They consider the warning when they've sent you the bill.
Okay. And then my second part is, you mentioned property and, life and health is an exemption. What is the grace period for that?
I believe it's 30 days. I believe it's 30 days, but we can get back to both of you.
Yeah, in health, there's a pretty specific statute. I believe it's 30 days, and there's sort of rules about what can happen in those 30 days.
That forewarning, that the bills, the forewarning, is that for the majority of states or just Maryland only? Because that's a terrible precedent.
I can't tell you as
Okay,
to.
thank you.
Yeah. And maybe Deputy Commissioner Hatchett will keep me honest here, but I don't, that may not be that, just because the law, there is not a law holding insurance companies to that standard, it also may depend on the actual contract that the insurance company has. This is not to say that no property and casualty insurer or policy doesn't have a grace period, but it's not required.
But what a company can't do
Right.
is, if we are members of the same company and we have policies with the same company, they can't say, oh, we like Marie, so she gets additional days. We don't like Joy.
Yeah.
She does not. Has to be across the board, because otherwise our market conduct would say you're acting in an arbitrary manner.
Yeah.
And we will not permit that.
Let the 2025 session begin.
Yeah. Well, thank you for being here. My question is more about technology. As we see more cars fitted with assisted self-driving, how is this being treated, or how do you think as a regulator it should be treated?
That's a great question, and one I'm not sure I can answer. I think we're monitoring the trends really, really closely. Again, I think there's a lot of risk that certainly the auto insurers in the space are taking a look at in pricing, but yeah.
And so there's not a whole lot of discussion yet about full self-driving, because I think it's pretty clear that's coming. I'll certainly say my father would never get in such a car, but maybe the esteemed chairman will. I mean, he has one, so.
They've been lying to us. I don't think it'll be here.
I mean, it seems like that would be bedlam for the industry, because of the simple fact that while there would still be accidents, they would be a lot more predictable, and there would be a lot more data, and there would be less need for insurance to be so expensive.
I think, so I have seen presentations in my first few months by self-driving companies, and I think trying to make the case that their products are very safe, right, and that the risk involved may be lower than human error. But I am not sure that.
We don't have
certainly-
those risk models, that's what you're saying.
Yeah,
Okay,
yeah,
got it.
and it's just so early, it's
Okay.
hard to tell.
Thank you. And
Yeah.
my last question is, you mentioned here with homeowners market hardening survey, that one of the factors is inflation and another, which makes sense because building materials cost a lot more and so does labor. But another is climate change. And when it comes to insurance, I'm always very careful because that's a moniker that could mean a lot of different things to a lot of different people. And I know I would be upset if the insurance company said your insurance is going up for your home because of climate change. I would want specifics. So my question for you is, are there specifics, rather than using this moniker, which is really meaningless? Are there specifics, like your house is by a bunch of trees and we've had a couple of windstorms there, or then there's a trend or something like that?
Yeah.
Or is it just a term that you're putting out there because it seems to be the term that's used a lot?
Yeah, that's a great question, Delegate Fisher. So I think, and I don't want to speak for my insurance company friends, but my experience with them is that they are not wedded to a philosophy on what might be happening. They are really wedded to the numbers of what they are seeing in their books and then what they can like physically
But that would be by
project
geography,
out.
even in Maryland. So for example, in Calvary County, we're surrounded by water. So there's probably maybe some other possibilities that could occur there, flooding and so forth. And, to me, that's called flooding. It's not called climate change. So I guess what I'm asking.
Yeah.
Well, we've always had flooding. So what I'm asking is, including in Calvert County, so what I'm asking is that why is there more of a detail? I know I'm having a debate here with my esteemed colleague, whom I love dearly. My question is, and this is important because I do get complaints in my county about the insurance rates. So this is a very serious question. They want to know, don't tell me climate change, tell me specifically why my house has this higher rate.
Yeah.
Rather than this moniker or because, oh, that must be what it is,
So I think there's a couple of ways the rates are determined, right? So there is the experience of what's going on in your county and the actual location of the home and the build
Fair enough.
of all of that. But there are other things the insurance companies can take into account under Maryland law. So first of all, that may be experience and losses, and some of that may look out of state, right? So that's the first thing. The second thing is the cost of reinsurance. So insurance companies work with reinsurers. Reinsurers assess the risk of what they're seeing. And so those costs getting built in are helping to contribute. So even, the rates your constituents are paying may not just reflect the storm experience in Calvert County, but it may be a broader reflection of what's happening in Maryland and nationwide and even worldwide.
Got it. Thank you.
Thank you. And actually, my question kind of follows up on Delegate Fisher's. So we have these issues, and the average consumer is not going to know any of this. All they know is, I've been paying my insurance, whether it's homeowners or car insurance, and now all of a sudden, my premium has jumped 200%. And they don't understand why. They don't necessarily understand about reinsurers.
Yeah.
They may not even realize that when they're with one of these particular national companies, national insurers, what's going on in California ends up affecting us, even though California has its own, whatever you called it.
Yeah,
I don't remember
fair
what you
plan.
said.
Yeah.
But so what happens across the country really is going to affect the rates based on what I understood you to say earlier, because it's a national company. So it's going to not only what happens right there in your own local area, but also how the risk is spread across, all of the ratepayers, right? So my question is, one, do we require insurers to let the ratepayers know about these things, such as the restrictions, and that even though I just got a 50-year roof this summer, that is really only 15 years, and that what's happening in Florida and California, even though I may not live in a floodplain or a high fire risk area, it still ultimately affects me because I'm with a national company. Do we require that these insurers let the ratepayers help them to understand what it is that, or why it is that their rates are going up? And I think that we should be doing that. We should be requiring the insurers to do that so that people will have a better understanding, and then they can actually make better choices because they may decide they don't want to be with a national carrier, but with a smaller carrier. So do we and can we?
I'm going to defer to Deputy Commissioner Hashaker.
So insurance is written in legalese. And so while they may tell you the factors and what is looked at, there's nothing in the law that says that it must be written in plain language for the average consumer. So the answer to your question is yes and no. Yes, they disclose, and there are so many different disclosures that insurance companies have to give. So between the policy contract and the disclosures, all of that information is there. But then, just because it's there, is it understandable? And do consumers actually read it? Most of the time, the only time a consumer looks at their homeowners or auto insurance policy is at the time of purchase, and they have no idea what it covers and what it doesn't cover. I mean, when you go to closing, there's so many papers there, you don't read any of that. Insurance company sends you a disclosure in the mail. And I can tell you from a consumer education and advocate, how many times I go to consumers and consumers complain to me and I say, well, you received this disclosure. And I hear one or two things. I don't ever remember seeing it. And did you expect me to read all that? So it's two prongs. It's not understandable, and even if it were understandable, would the consumer actually read it?
Well, I think I might argue that if it were understandable, more consumers would, or at least would attempt. So everyone may not, because it is so much paper and so many words. But I would argue that if it were a little bit more understandable, that there will probably be more people to take the time to try to get a better understanding.
And I don't want to disagree with you, but I do. My consumer education and advocacy unit, we do over 500 events a year. We have information on the website. We have pamphlets, brochures that explains all of this to consumers.
All right.
And a lot of consumers just aren't interested.
All right.
And I get it. I mean, insurance is not easy.
Thank you.
Thank you. Just for the members kind of being up here, this is the first time with this system. Sometimes when you hit your button, if it takes a while because people ask very lengthy questions, they go off. And so, just be a little bit patient. I know that happened a few times, and we have a boomer chair, so it's going to take them a minute to catch up to technology. That concludes today's hearing. Thank you so much, Madam Commissioner. Really appreciate you coming. And see everybody tomorrow.
Thank you all.
Deputy Commissioner.